Sharina V. Dapar, and for today's video, I am going to discuss about supply theory. So first, what is supply? Supply means the amount of a resource that firms, producers, laborers, providers of financial assets, or other economic agents are willing and able to provide to the marketplace or to an individual. Supply can be in produced goods, labor, time, raw materials, or any other scarce or valuable object. So there are two supply theory. First, firm supply. Second, industry supply. So the first category is firm supply, means a distribution supply that can withstand any single contingency within the distribution network. Second category is the industry supply, means the supply for qualified industrial purposes in factories, including the supply required for the offices and for normal working of the industry.
The first supply is firm supply.
So let's talk about first the firm supply. Here in firm supply, there are four categories. First, types of firms. Second, supply function. Third, law of supply. Fourth, producers supply.
First category is types of firms.
First firm supply is types of firms. So there are four categories in types of firm. First, sole proprietorship or sole trader. This type of firm is controlled by a single individual responsible for all expenses and responsibilities and owns all assets. Although it is uncommon for single proprietor companies to function as firms, it does occur. Second, corporation. The financial statements of the companies are kept separate from those of the proprietors. The company owners are not responsible for the business expenses, litigation, or other responsibilities. Individuals or governments may own corporations. Corporations, commercial entities may act similarly to people. They may take out loans, engage in contract agreements, and pay taxes, among other things. A company is often used to refer for a business that several individuals own. Third, partnership. This type of firm is a partnership owned by two or more individuals. The number of partners is unlimited. Each partner is personally responsible for all company responsibilities, and collectively they control the firm's assets. Fourth, financial cooperative. This type of firm is comparable to a corporation in that its owners have limited liability. Still, investors have a voice in how the business operates.
Second category is supply function.
The second firm supply is supply function. So, supply function is a numerical portrayal of the association between the amount expected of a product or service, its value, and other related factors. For example, related products cost and input cost. A supply function has numerous individual dependent variables and independent variables.
Third category is law of supply.
The third supply firm is law of supply, means is a fundamental principle of economic theory which states that keeping other factors constant, an increase in price results in an increase in quantity supplied. In other words, there is a direct relationship between price and quantity. Quantities respond in the same direction as price changes.
And lastly is producer surplus.
And lastly in firm supply is producer surplus. So producer surplus is the difference between how much a person would be willing to accept for a given quantity of a good versus how much they can receive receive by selling the good of the market price. The difference or surplus amount is the benefit the producer receives for selling the good in the market. Producer surplus is generated by market prices in excess of the lowest price producers would otherwise be willing to accept for their goods.
The second supply is industry supply.
So let's proceed to the second supply theory, which is the industry supply. And this supply have three categories. First, industry equilibrium in the short and long run. Second category, zero profit. Third category, rental rate and prices.
First category is industry equilibrium in the
First
short and
category
long run.
is industry equilibrium in the short and long run. Since the price of a product under perfect competition is determined by the intersection of the demand and supply curves of the product of an industry, we need to know the nature and shape of the supply curve of a product under perfect competition. We shall now explain how the supply curve of a product under condition of perfect competition as derived and shape it takes both in the short run and the long run.
Second category is zero profit.
The second category is zero profit. The zero profit condition is the condition that occurs when an industry or type of business has an extremely low cost of entry to or exit from the industry.
And lastly is rental rates and prices.
The three categories: rental, rates, and prices. So this means rental price means the amount of the charge for renting the qualified heavy equipment, excluding any separately stated charges that are not rental charges, including but not limited to separately stated charges for delivery and pickup fees, damage waivers, environmental fees, sales tax, or any other ancillary charge.